Good afternoon to you all, and thank you for coming to this special forum on business ethics entitled How Bernie Madoff Scammed the Experts. We have two speakers with us today. The first is Mr. Joseph Aaron. Joe Aaron is the general partner of Wood, Hat, and Silver, which is a firm based in Sonoma that researches alternative investments and hedge funds. He entered the alternative investment business in 1995 after an extensive career in various financial institutions and a decade with the FBI. He's probably more known for about a number of years ago, in 2003, or probably even earlier than that. He was one of those hedge fund managers who warned about Bernie Madoff and actually contacted the SEC and various investors about him. So he's going to provide his perceptions to what has happened in that particular crisis, what happened in that particular scandal. Then after his presentation, we have Dr. Harlan Stelmach, who's the chair of our Department of Humanities at Dominican, and also the author of Doing Ethics in a Diverse World, to give his, I would say, an academic perspective of this particular situation, of this particular problem, and then we'll open it up to a Q&A. People are still trickling in, and so I guess we can think there's enough room there, so we can proceed with our presentations. Joe?
How you doing, everybody? Thanks for coming. And the applause is not obligatory. I'm going to spend about 5 minutes. It's 12:11. I'm going to spend about 5 minutes on the history of hedge funds, because nobody really knows what they are. And when we finish in 5 minutes, you're going to know more than 99.9% of the people about hedge funds. Trust me. I promise to be entertaining, informative. You're going to like it. You're going to learn a lot. You will not nod off, even if you just had lunch, because I was in school at one time myself. The hedge fund was literally invented by a gentleman named A.W. Jones. A.W. Jones invented it when he was 49 years old. In 1950, he opened his fund, which was called the Fully Committed Investors LP. He was a writer for Time magazine. He was from Australia. He was a socialist, and he was a writer for Time, and they sent him on a project to investigate money managers. And he spent about 1.5 years interviewing money managers. And before the story was published, A.W. Jones had opened the Fully Committed Investors Fund, and he had resigned. He put $100,000 of his own money in to start it. And $100,000 back in 1950 was a lot of money, trust me. That was impressive. He was what I call a trust fund baby. He was, from a very well-to-do family and from Australia, etc. He invented something I think is truly remarkable. He took two of the most risky speculative investment techniques known to man and combined them to form one of the most conservative investment vehicles I think has ever. It's really unique. He's in financial terms, I would qualify him as a great man. Nobody in his family liked him. He was nasty. He was short. He was rude. He worked everybody to death. But he was very, very, very successful. Now, the two investigative techniques, and I'm going to slow down as I speak, which is easy for a Southerner, and you're going to have to pay close attention. If I lose you here, I've lost you. When you short a stock, a show of hands, who knows what shorting a stock is? That's not enough. Okay. Shorting a stock is a bet, or you're putting your money at risk. You're betting the value of that stock will go down in value. So if you thought Bank of America was going to go down in value 6 months ago, what you would have done is go over to Paul, who happens to have a few hundred shares of Bank of America, and you borrow them from Paul. And you pay Paul a pittance, 1, 2, 3 cents for borrowing it. Then you go over this side of the room and you sell it. in the open market. So let's say I sold that Bank of America stock for $25, and I had 100 shares. Well, if the stock starts falling, as it has, I could go back in today and buy that 100 shares back in the open market for what, $3, whatever it is. And then I go back and hand Paul his 100 shares again. So I just keep the rest in my pocket. That's what shorting does. The problem with shorting is that and this is what makes it risky, had Bank of America doubled in price from $25 to $50, I would have to post collateral. I would have to keep putting up money. Well, what if it went to 100? I've lost money. What if it went to 200? Oh my goodness. You can lose unlimited money shorting stocks. Very risky. All right. Now, the other one that A.W. Jones used was leverage. Now, we all know about leverage. That's called buying on the margin, right? You got $10,000 and you buy $20,000 worth of stock. Well, the good news is if it falls like the market has, you can only lose your $10,000. That's the good thing if you invest $10,000, but if you leverage it and you buy 20, you're going to be wiped out. You're going to be wiped out twice as soon. Or twice as quickly. So A.W. Jones combined leverage and short selling, and it became a very conservative investment, and I'll explain why. Because I'm at 5 minutes, I'm going to do it quickly. How many here have heard the concept of an efficient market? Okay, not enough hands. Efficient market means you can invest in 10, 20, 30 stocks, and you're not going to outperform the market or underperform the market. You're going to do about the same as the market because you took the same amount of risk. But if you buy 3 stocks, you're taking more risk. You might double the market's performance. You might trail it by 50%. That's called an efficient market. A guy won a Nobel Prize off of that. If money managers will all say, well, we performed as well as the market. They refer to it as relative performance. Well, let me tell you, investors can't spend relative performance. They can't do it. So you expect your money managers to outperform the market. So A.W. Jones took leverage. He had, let's say, $1 million, and he bought $1,500,000 worth of stocks that he thought he was going to go up in value. Now he takes $750,000 and goes short. Bets these stocks are going to go down in value. So he's got $1.5 million long, and he's got $750,000 short. So his net exposure to the market is $750,000. So if the market goes up 4%, he should go up 3% if you believe in the efficient market, which most people do. But if he's a better picker of stocks than the others, he has magnified his returns. Because if his longs go up 4%, if the market goes up 4%, his longs should go up 5%. So mathematically, it's in his favor. His short stocks shouldn't go up as much as the market. They should only go up 3%, and therefore he would lose 3% on his $750,000. All right. So A.W. Jones had $750,000 long and $750,000 short. That's called being in the hedge, right in the middle of it. He had gross market exposure, his longs plus his shorts, which would be $2.25 million, with the opportunity to make returns on his $1 million. And A.W. Jones, his $100,000 became $10 million in 35 years. They wrote an article about him 20 years later in Fortune, and they referred to him as the Jones nobody could keep up with. He invented beta. He called it velocity. He could have won a Nobel Prize. You invent this stuff, but he was using beta and alpha even back then. Okay, the hedge funds emerged today and to something we call a hedge fund is just a limited partnership, I guess is all you can say it is. But it's fees. It's 1%, 2%, just because they got $1 billion, and 1% of the profits. So people will say, well, you got to watch these high fees. Well, let me tell you about a money manager you've never heard of, Stevie Cohen, SAC Capital. Stevie Cohen has been managing money since '92, and he's averaged 45% a year until the last couple of years when he's only done 10 or 20, and 45% a year. Now, what are his fees? Stevie Cohen charges all of his expenses to the fund, all of them. And they're not 1%, they're not 2%. They run about, I've heard 3%, but I suspect it's closer to 5%. So he made this 45% a year after he charged you expenses of the fund. But that's not the real exciting thing. He charged 50% of the profits. So Stevie Cohen made about 100% a year. 100% a year. And he went from having essentially nothing to he's probably worth $10 billion today, and you probably haven't heard of him. Well, when you can charge people 1% of the fees, they get excited. That's a real high margin business, because typical money management charges 1/4 to 1/2 point to 1%, 1.5%, whatever. So this brings us to Bernie Madoff, which Joe brings up is the largest fraud in the history of mankind. By a multiple. This is the Tiger Woods or the Muhammad Ali of frauds. How did he pull this off? Well, psychologically, I think he pulled it off because he said, I don't want your money. I'm full. The fund is full. We can't take your money. But the fact is, he would take your money. Now, Bernie Madoff ran what we call a broker-dealer. Goldman Sachs and Morgan Stanley, Payne Weber, Kidder Peabody, all these firms you've heard, they're broker-dealers, right? And they're subject to rules. It used to be NASD, now it's called FINRA. And Bernie Madoff had a well-known firm, and it's a low-margin business, though. You don't make much money in a broker-dealer. There are no Forbes 400 richest people that own a broker-dealer, all right? All right. The next thing, that's the first way he escaped it, because if you manage money for people and you charge them either 1% of the assets, you got $1 million, 1% of the assets, $10,000 a year. Right? Or if you charge them 1% of the profits, hedge funds generally do 20 to 50, then you have a different set of regulations. In the state of California, if you have under $30 million, you have to register with the state as a registered investment advisor, and they can, quote, unquote, supervise you. Well, they don't have enough money to do much supervision. But when you get above 30, actually it's 25 million with the SEC, they require you to register. Now, there's two requirements. One is over 25 million, and the two is over 15 clients. If you have 14 clients, you don't have to register. A hedge fund is one client. All right. Bernie Madoff challenged all the regulatory agencies saying, I don't have a registered investment advisor license. I don't need it as a broker-dealer to manage somebody's money, but I'm managing the money of a hedge fund who sent me their money to manage. And I don't charge a percent of the assets. I don't charge an incentive fee. I charge commissions, as I'm legally authorized to do as a broker-dealer. So he's technically right in every sense, but he still fooled them, which I guess I'll get into. Madoff was visited by the regulators, I'm going to say about 4 or 5 times. But all of us in the hedge fund business, there were 2 camps: the believers who consumed the Kool-Aid and the non-believers who said he's absolutely a Ponzi scheme. I was just one of those hundreds who was in the Ponzi scheme corner. There's nothing unique about Joe Aaron. I just happened to be here. A lot of people in the business thought he was a crook. In 1992, the first time the SEC came in, there were 2 accountants who had been CPAs, had been sending him money. They had sent him $440 million. That was a lot of money in 1992 as well. His returns were 13 to 20% per year. He sent the money back. He wasn't cheating. He wasn't stealing. He had the $440 million. He was doing what they call convertible arbitrage. That's a hedge fund strategy. Convertible arbitrage is long the convertible bond and short the company stock. Long Coca-Cola bond, short the stock. So the convertible bond could be converted into the equity, and that's a very, very successful hedge fund technique that was not known by many people. And I believe he could have done that. I doubt it, but I believe he could have. Right? Once it was discovered and everybody started doing it, convertible arbitrage fell apart. People lost money. Then in 1999, they didn't come back. The SEC made him send the money back. Didn't hear from him again. In 1999, 2000, the SEC looked at him for what we call front running. Front running. He's a market maker in securities, and so he's matching buyers and sellers. And so if he sees I've got all these buy orders over here, it's going to go up. So I'll put my clients in front here. We'll buy at $10 and let these other people start buying it. It'll move it to 10 and a quarter, 10 and a half, 11. Then I'll take my people out. That's called front running. He outlined some new procedures. They slapped his wrist. Nothing would happen. In 2001, there's a guy named Markopoulos, and he's the real deal. He went to a lot of trouble, wrote up a lot of papers, and actually sent it to the SEC. I've read it. I met him at a conference. He was just another Madoff critic, and he and I hit it off, and we talked about it and said, gee, sooner or later they'll discover it, and nothing happened. But this guy goes to the SEC, your government goes to the SEC's office and presents it to him. And why didn't they get it? I don't know. I can't tell you other than I use the big number. They don't have a concept of big numbers. The SEC enforcement division is run by attorneys, not anybody with an understanding of math. You need math if you're going to catch a Bernie Madoff. Let me give you his investment technique was a split strike conversion. It's just options to protect you on the downside, options to help you on the upside, and then owning a basket of stocks. There's nothing unusual about that. Tons of people invest that way, but they lose money. Bernie Madoff didn't lose money. So let me just put it this way. If a stock trades 1 million shares a day on average, you can say, well, the stock trades at $50 a share, you can figure out how much money has changed hands that day on average. Well, if you looked at all the OEX, which was a basket of stocks on the S&P, the S&P 100, I think it is, Bernie Madoff at the end was running $15 billion. There was only about $3 billion worth of business done each month. So we should figure it out. He was the entire market, you know. Now, you know, I say you don't have to. Telling the dean here that I graduated from the 11th best college in Georgia, and I can do that math. But they're lawyers, and they're smarter than the rest of us, so they never caught it. Also in 2001, Barron's, everybody knows Barron's Magazine, they did a excellent piece, and boy, they just pick right at it. And without saying he was a fraud, they said he was a fraud. You know, you have to be careful when you're the press. And another industry rag that most of us subscribe to called Hedge, they said he was front-running or fraud. And how much do you need to hear? But it didn't work. And in 2004, the SEC again looked into front-running. Nothing happened. And in 2005, now this is where they came close. This is where they should have got him, 2005. The New York office came in and said, you got 16 clients, and you got $8 billion back in 2005, had $8 billion. And he said, you know, I don't need to register. I'll get rid of one of these clients, so I'll only have 15, and I'm just managing 15 different accounts for 15 different hedge funds. One of those funds would have been the feeder fund you hear about. You may have heard of Fairfield Century, which had invested $7.5 billion with Madoff. Now, Fairfield Century charged their investors 1% management fee and 20% incentive fee. Now, you know, we can do that. It's just zeros. You can do that math. You know, they're making a ton of money. When you're making that kind of money, you just don't want to look too hard into the mouth that's feeding you. Mother bird's feeding you. You don't want to look too hard at it. You don't want to be critical. You don't want to believe it. Get away. No. It's in your financial interest. Never confuse somebody wearing a coat and tie and having pretty offices with integrity. You know, in this business, if your mother tells you she loves you, you better check it out. You know, these people will take advantage of you because your money is my income. That's the way I make my money. You know, I talk you into giving me your money. I'm always conservative. We always do the conservative thing. We don't take any risk, and yet they're down more than the market. Okay. Let's see. Madoff claimed he did all his trades from 2:49 a.m. to 8:57 a.m. outside the United States. Well, you know, go back to that $3 billion number, and then you just reduced it to about $500 million that you're able to do in a month. That's incredible. They spent 4 days, the SEC did, looking at statements. Concluded it matched the strategy. Now, he created these statements. They concluded it matched the strategy, but nobody seemed to know in bear markets this strategy loses money. And FINRA, which is NASD, that's the third team. That's the third. We don't have a second team. You have the SEC as your first team. Then there is no second team, and then FINRA. They're and I don't mean to offend anybody. You know, it's minor league. It's very minor league. My 20 minutes is up. Professor?
Oh, you're looking at me.
Yeah.
Thanks, Joe. And thanks, Luis, for inviting me. I'm delighted to be here. How to enter this discussion is going to be an interesting task. Maybe the first place of entering, Luis introduced me as someone who's going to give the academic perspective as opposed to some other perspective. I'm not sure what that actually means, but in reading some of the materials about this whole scandal, there's a major article that's on the website that deals with his psychology, it deals with his whole sales strategy, it deals with everything about this whole thing, and ethics is never mentioned once, except when it said a number of academics thought it was unethical. A number of academics thought it was unethical. So maybe we have a role, after all, in this whole discussion. So Now, Joe gave you the lesson on hedge funds. How many of you absorbed, now be honest, we're talking about ethics now, how many of you have absorbed 90% of what he said about hedge funds? How many absorbed?
Raise your hand a little higher.
Yeah,
be
higher.
proud.
90.
Be proud.
Are you business majors? Yeah, okay. How many absorbed, say, 50%? How many maybe 25%? Well, also, Luis gave me an article to read as background for this, and I've never seen such mystical language since I was reading about medieval Christianity. I mean, it's very difficult to understand any of this. So it does raise the question in terms of us as dealing with an issue like this, is how do you become informed enough to be able to sense it? I mean, most people said, and you read the literature, it was too good to be true. It was too good to be true. It was too good to be true. I mean, they said it over and over, didn't they? But nothing was done. So somehow there needs to be a larger group of people that's sufficiently informed that are capable of acting on something like this. All right, so let me read one of the psychological profiles of Bernie Madoff, and it says, he knew what he was doing was wrong, but he was making people happy, so he never had to deal emotionally with the idea that he was hurting anybody. Now, when you think about this, this is just not about him. In a sense, it's about us as a culture to some degree. So some of the people who knew it was too good to be true, when they did all the math and statistics, thought he was doing it illegally. They didn't realize they were and so they invested with him, and so they were getting the payoff as well. They didn't realize it was going to be a full Ponzi scheme. Obviously, Joe said a lot of his colleagues really had a sense of what was going on. It really was a Ponzi scheme. But a lot of people intentionally invested with him to make money with the thought that somehow he had some insider trading information. That's how he was getting these numbers. So, to some extent, morality and ethics in a situation like this, you have to be connected in some way. If you distance yourself from the actual fact of what's going on, you can write it off. So it wasn't so much self-deluding. He was never close enough to really see the hurt of people, according to this notion. And that's kind of like us, and that's why I want to bring us back to at least one area of ethics that's so important for the tradition, and that's of character. So what kind of character, what kind of virtues did he manifest, and what kind of virtues do we ask for in the people that we admire, that in fact we think are successful? So I was struck, Joe, and not to put you on the spot, but you did call A.W. Jones a great man. He was nasty, brutish, and short, and probably you wouldn't even want to go out a beer with him, perhaps.
Exactly. Yeah.
Right. But you said he was a great man because he was successful. And he created wealth, basically. So our society puts a lot of stake in who creates wealth. So, and our society, and I don't want to generalize it, I put a lot of stake in that. We all put a lot of stake. We want to be part of that wealth factory that our society produces and our economy produces. The problem is we have to balance that with a few other lenses we use, not only about someone else's morality, personal morality, our personal morality, but also public morality as such. So what happened in all of this is a product of what we helped create. And if we want to put it off on Madoff, that's the wrong place to put it right now. Sure, he was a criminal. Sure, he was fraudulent. Sure, he did all this. But he was in a culture that oftentimes needed to look the other way. And that's where it comes back to us. Clearly, in terms of ethics, Madoff thought he was above the law as well. He thought he was above the law. We impeached a president because he thought he was above the law, right? But somehow this guy was above the law. We couldn't even get him to register in a normal way around the regulation. Okay, well, that's a sure sign something's going wrong there. Common sense at some level tells us where the red flags are in terms of morality as well. He broke what he did to whole society in terms of confidence. He abrogated relationships throughout every single contact that he had, the foundations that he sat on, and boards, and investing their funds. He could invest the funds of these nonprofit organizations with major endowment funds, and they wouldn't really know what was going on because they weren't after the money right away. So he was taking advantage of people that he was in fact sitting with, having tea with, having coffee with, having lunch with, but he wasn't hurting them, and they didn't even, because it's at such a distance. This is an incredible individual, and maybe isn't too much different than who we are. He also thought he was creating happiness in some people. You know, they're doing well. There's some returns here, and in a sense, the common good is increased. The wealth is increased. Again, just one lens. We know when something isn't right. We know when something isn't right. Did I say we know when something isn't right? We need to follow up on that. If we can't universalize our act to apply to everybody, so Madoff violated one of the basic principles in the whole ethical tradition. He couldn't universalize what he was doing to apply to him. What if someone else had his money doing what he was to others? Would he be able to live with that? He couldn't. And in a sense, he created an inconsistent, self-contradictory situation that got himself, his family, so many other people in trouble, and is sort of the tip of the iceberg for what we're dealing with even in economic crisis. I'll leave it at that, and we can have a conversation. That's very good.